Finance doesn't serve the economy anymore. The economy serves finance. That sounds like activist rhetoric, but it's the most accurate description of how modern capitalism actually functions. Companies don't use financial markets to fund production. They adjust production to satisfy financial markets. Governments don't regulate finance to protect the public. They protect finance to maintain economic stability. Workers don't save money to build wealth. They borrow money to participate in asset inflation. The relationship flipped quietly, without announcement, and most people still think they're living in the old system. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. When people imagine finance, they picture banks taking deposits and making loans, investors funding innovation, markets efficiently pricing assets based on productive value. This feels natural because it describes how financial systems were designed to work. Money was supposed to be a tool that made other economic activity more efficient. Finance was infrastructure, not the destination. But that was never the full story, and it's definitely not today's story. The transformation began when finance discovered something more profitable than serving the economy, reshaping it. Instead of allocating capital to existing productive activities, finance learned to create new asset classes, new markets, and new ways to extract value from activities that already existed. This wasn't an accident. It was innovation. And like most innovation, it started small and spread systematically until it became the dominant logic. To understand how dramatic this shift was, consider how finance operated for most of the 20th century. Banks were heavily regulated, geographically constrained, and functionally limited. They took deposits, made loans, and earned the spread. Investment banking was separate from commercial banking. International capital flows were restricted. Financial innovation existed, but slowly. Most importantly, finance was subordinate to other economic priorities: full employment, industrial growth, and social stability. This wasn't because regulators were wise or bankers were restrained. It was because the financial sector was small relative to the rest of the economy. In 1950, finance represented roughly 10% of corporate profits in the United States. By 2000, that number had reached 40%. Finance didn't just grow, it metastasized. But the numbers only tell part of the story. The real change was logical. Finance stopped being a service sector and became the organizing principle for everything else. This shift has a name: financialization. And once you see it, modern economic behavior starts making sense in ways that traditional economics cannot explain. Here's how financialization works in practice. A pharmaceutical company develops drugs not primarily to treat disease, but to generate patent-protected revenue streams that produce predictable cash flows for investors. The therapeutic value matters, but the financial engineering matters more. Which diseases to target, which research to fund, which treatments to price accessibly. All these decisions get filtered through financial return calculations first. Consider the mathematics that drive drug development under financialization. Rare diseases affecting small populations become attractive because they command premium pricing with minimal competition. Chronic conditions requiring lifetime treatment become priorities because they generate recurring revenue streams. Preventive treatments that might eliminate diseases entirely become economically problematic because they destroy their own markets. The optimal drug from a financial perspective treats symptoms indefinitely without curing the underlying condition. This doesn't make pharmaceutical executives evil. It makes them rational actors in a financialized system. When stock performance determines CEO compensation, when quarterly earnings drive share prices, when shareholder value is the legal priority, optimizing for financial returns becomes survival strategy, not conscious choice. The system rewards thinking like a financial portfolio manager first and a healthcare provider second. The same logic captures agriculture, where farming increasingly serves financial rather than nutritional objectives. Crops get selected not for nutritional density or environmental sustainability, but for commodity market performance and derivative trading potential. Land gets consolidated into larger holdings because financial institutions prefer assets they can securitize and trade. Small farmers get displaced not because their farming is inefficient, but because their scale doesn't generate the cash flows that financial markets can monetize. The same logic appears everywhere. Universities don't just educate students. They manage endowments, develop intellectual property portfolios, and structure degree programs around debt-financed revenue models. Corporations don't just produce goods. They manage supply chains as financial instruments, using just-in-time inventory to optimize capital efficiency rather than production resilience. Even governments increasingly function as financial entities, issuing bonds, managing pension obligations, and treating public assets as potential revenue sources. None of this happened through central planning. It happened through incentives. As finance grew more profitable than other economic activities, talent, capital, and political influence flowed toward financial optimization. And as financial optimization became dominant, everything else adapted to serve it. This is where the system's true innovation becomes visible. Financialization doesn't destroy productive activity. It subordinates it. Factories still produce goods, but primarily to generate cash flows. Workers still provide labor, but increasingly to service debt obligations. Innovation still occurs, but focuses on creating new asset classes rather than solving material problems. The economy continues functioning, but according to financial rather than productive logic. And that's the part that makes financialization so stable. People can see that something has changed, but the change feels like evolution rather than revolution. Companies still make products. Workers still receive paychecks. Markets still allocate capital. The mechanisms look familiar even as their purpose shifts fundamentally. Consider housing, which reveals financialization's logic most clearly. In a production-oriented economy, housing exists primarily to provide shelter. Price reflects construction cost, land availability, and local demand for places to live. But in a financialized economy, housing becomes an asset class. Price reflects investment demand, credit availability, and expected appreciation rates. Shelter becomes secondary to investment returns. The transformation is measurable. In major cities, housing costs now consume 40 to 60% of median household income, compared to 20 to 30% in the 1970s. But this isn't simply supply and demand. It's the result of housing being optimized as an investment vehicle rather than as shelter infrastructure. When housing becomes an asset class, scarcity becomes profitable rather than problematic. Financial innovation accelerated this shift. Mortgage securitization allowed banks to package housing loans into tradable bonds, disconnecting local housing markets from local lending decisions. Real estate investment trusts converted rental properties into stock market investments. Foreign capital flows treated housing markets as safe harbor assets during global volatility. Private equity firms began purchasing single-family homes as institutional investments, competing with individual buyers using financial leverage individual buyers cannot access. This transforms everything. Cities prioritize development that attracts capital over development that houses residents. Luxury condominiums rise while affordable housing disappears because luxury units generate higher financial returns per square foot. Zoning laws protect property values rather than housing supply because existing homeowners become investors whose wealth depends on scarcity maintenance. Homeowners support policies that inflate asset values rather than policies that ensure affordability. Banks create financial instruments that treat housing as collateral for increasingly complex derivative products. The entire system optimizes for housing as investment rather than housing as shelter. The result is a housing market that functions beautifully for financial purposes and terribly for housing purposes. Prices rise faster than incomes. Construction focuses on luxury rather than necessity. Young people can't afford homes, while older people accumulate housing wealth they never planned to use. The system works perfectly according to financial logic and fails completely according to human logic. But housing is just one example. The same pattern appears across every asset class that can be financialized. Education becomes student debt. Healthcare becomes insurance products. Retirement becomes pension fund management. Infrastructure becomes public-private partnerships designed around revenue extraction. Even art, collectibles, and intellectual property get incorporated into financial portfolios as alternative asset classes. Each transformation follows the same sequence. First, financiers identify an activity that generates predictable cash flows. Then, they create instruments to capture those flows as tradable assets. Finally, they optimize the underlying activity to maximize financial rather than social returns. The activity continues. but its purpose changes from serving human needs to serving financial needs. This is not inherently malicious. Financial markets are exceptionally good at allocating capital efficiently, managing risk systematically, and creating liquidity where none existed. These capabilities generate real value. The problem emerges when financial optimization becomes the primary objective rather than one objective among many. When finance was constrained and subordinate, it improved other economic activities without dominating them. But when finance becomes dominant, it transforms other activities into inputs for financial production. The tail starts wagging the dog. And once that happens, the system optimizes for financial returns even when those returns come at the expense of everything else. This explains why modern economies can generate enormous financial wealth while simultaneously experiencing infrastructure decay, education underfunding, healthcare rationing, and housing shortages. The wealth is real, but it accumulates in financial assets rather than productive assets. GDP grows, but most of the growth reflects asset appreciation rather than productive capacity expansion. Financialization also explains why economic inequality has accelerated in developed countries. Financial assets appreciate faster than wages, and financial assets are concentrated among people who already have capital. Workers participate in economic growth primarily through debt rather than ownership. This creates a feedback loop where financial wealth enables more financial investment while wage dependence becomes more precarious. The system becomes self-reinforcing. As finance grows relative to other economic sectors, political influence flows toward financial priorities. Policies that support asset values take precedence over policies that support wage growth. Tax structures favor capital appreciation over labor income. Regulatory frameworks prioritize financial stability over financial constraint. The political system adapts to serve financial rather than productive interests. But perhaps the most significant effect of financialization is cultural. When everything becomes an asset class, social relationships begin reflecting financial logic. Education becomes human capital investment. Marriage becomes household financial optimization. Parenthood becomes long-term care insurance. Friendship networks become professional networking. Even personal health becomes wellness investment with expected returns. This doesn't mean people stop caring about love, learning, or relationships. It means those values get expressed through financial frameworks that often distort them. People take on crushing debt for education they're told will pay off financially. They delay having children until they've achieved financial stability that keeps receding. They relocate repeatedly for career opportunities that optimize lifetime earnings at the expense of community ties. The cultural effect is crucial because it makes financialization feel voluntary. People choose to treat their lives as investment portfolios. They choose to optimize for financial returns. They choose to prioritize asset accumulation over other values. But these choices occur within a system that rewards financial optimization and penalizes alternatives. The choice is real, but the context is engineered. This is how financialization maintains political support despite producing outcomes that many people find unsatisfying. The system doesn't force participation through violence or coercion. It creates incentives that make participation feel rational and resistance feel irresponsible. When asset prices are rising, people who don't participate feel foolish. When asset prices are falling, people who don't have assets feel exposed. The psychology becomes adapt or fall behind. And adaptation means internalizing financial logic as personal wisdom. People learn to think like investors even when they're not investing, to optimize for returns even when they're making life decisions, and to measure success through asset appreciation even when they care about other things. But financialization contains its own contradictions. As more economic activity gets organized around financial returns, the underlying productive capacity that generates those returns begins to deteriorate. Financial optimization often conflicts with productive optimization. Short-term returns clash with long-term investments. Asset appreciation diverges from economic output. Eventually, the financial system becomes disconnected from the productive reality it's supposed to represent. When that disconnection becomes extreme, financial crises occur. Not because markets fail to operate efficiently, but because they operate efficiently according to financial logic that no longer reflects economic reality. The 2008 crisis was not a failure of financialization. It was financialization working exactly as designed until the contradictions became unsustainable. But even crises don't reverse financialization. They accelerate it. When financial systems collapse, governments intervene to restore financial stability rather than reduce financial dominance. Central banks provide liquidity to financial markets. Fiscal policy supports asset prices. Regulatory reforms typically make the financial system more sophisticated rather than more constrained. This is because by the time financialization becomes dominant, rolling it back would require dismantling most of the economic structure that depends on it. Pension funds, insurance companies, university endowments, municipal bonds, corporate financing, international trade. All of these systems now operate through financialized mechanisms. Constraining finance would require reconstructing how modern economies function at a fundamental level. That's the trap of financialization. It starts as a tool and becomes the foundation. And once it's the foundation, changing it means changing everything else. People recognize the problems, but can't imagine alternatives that don't depend on the same financial mechanisms that created the problems. So the system continues expanding, finding new activities to financialize, new asset classes to create, new ways to extract value from economic activity that used to operate according to different logic. The process accelerates because finance has both the capital and the political influence to reshape whatever it encounters. Understanding financialization doesn't offer easy solutions, but it offers clarity about why modern economic life feels simultaneously prosperous and precarious, dynamic and unstable, full of opportunities and impossible to navigate. These aren't contradictory experiences. They're different perspectives on the same transformation. Finance stopped serving and started ruling not through conquest, but through innovation. It created tools so effective at generating returns that using them became necessary for economic survival. And once those tools became necessary, everything else adapted to serve them. The economy still produces goods and services, but increasingly, it produces them as inputs for financial production rather than outputs for human consumption. That's not collapse. That's evolution. And evolution doesn't reverse direction just because people don't like where it's headed. Systems don't change because they're unfair. They change when they're unprofitable. And financialization remains extraordinarily profitable for those positioned to benefit from it. Everyone else adapts, complains, or falls behind. But the logic continues expanding because the logic continues working. For those positioned right, financialization offers opportunities for wealth accumulation that previous economic systems couldn't match. For those positioned wrong, it offers debt, precarity, and the constant pressure to optimize their lives according to financial criteria they never chose. Same system, different experiences. That's the final lesson of financialization. It's not broken. It's working exactly as designed. The question is, working for whom? And at what cost to everything else?